What's up everybody, Justin here, and you're just in time for another video. Today I'm going to be going over the basics on why the Silicon Valley Bank collapsed and my thoughts on it. Let's get started. It's time! The old saying goes that history tends to repeat itself. And in this case, there are some eerie similarities between the 2008 bank collapse and today's current bank collapse. Now, this situation isn't completely over, and more details and new events are still happening, but I do say we have enough information to paint a picture as to what happened in 2008. The basic story is loans were given out, and then when those loans were called, the bank couldn't come up with that money. People flocked to the bank to pull out their money, and banks, in typical bank fashion, they don't hold all of your money in cash. They hold a small percentage of it. The rest that people have deposited into those banks gets invested. It gets invested and lent out so they can earn a return on that money, ultimately profiting from it, and then allowing you to earn a small percentage in your savings accounts. That's how it works. And so when everyone flocks to the bank to pull their money, the banks don't have that cash on hand. They have to try to liquidate their assets. And in 2008, when the banks tried to liquidate assets, they called loans and people didn't have the cash, thus resulting in a bank collapse. The Silicon Valley bank collapse is eerie similar to what happened in 2008. The differences are this was brought on by the tech boom. That's right. Do you remember in the pandemic when all these tech companies were just taking off? You know, people with, for instance, with stimulus checks were like, what am I going to do with this extra cash? Boom, flood it into the stock market. Tesla stock went up. You can see Google, a bunch of different other tech stocks and tech companies profited major in this boom period. When this boom happened, what did these companies have to do with all this extra cash? What they did is they put it into Silicon Valley Bank, which is a major holder of these tech companies' accounts. So they have all this money from these tech companies. And I'm not talking, thousands of dollars. I'm talking in the billions of dollars that these tech companies had put into the bank. Now, these tech companies might not have put all of their money into the Silicon Valley Bank, but billions of dollars worth of money went into this bank. And what did the bank do? Well, one of the general consensus is they went and bought bonds with the federal government. Bonds are a really safe and secure asset. If you're looking to, diversify your portfolio, putting a small percentage of your money into bonds is a great idea. The returns aren't the highest, but they're guaranteed by the federal government. And when you wait the allotted time for that bond, you're going to be making the guaranteed interest rate. In this case, what happened is the Silicon Valley Bank over leveraged the amount that they put into bonds. And what happened is when the boom period of this tech boom started dipping down and these companies needed money, what they would do is they'd go to the bank and try to get some of their money so they could make payroll and they could stay afloat during this downtime. SVB had to go get the cash for these companies and individuals. They had to go call their bonds. But lo and behold, they bought these bonds during the tech boom. In that period of time in 2020, 2021, we had all-time low interest rates. What that means is these interest rates were extremely low. So now what SVB needs to do is they need to sell their old bonds in order to liquidate those bonds and get cash for it. The issue is with the Fed increasing rates, the bonds that they hold are a discount of what people could get for a bond today. When they're trying to sell these old bonds at a lower interest rate, they're getting cents on a dollar for it. They have to sell them at a discount, which means selling them at a loss because they just can't compete with the increased interest rates. That means the bonds are worth more. If you were to buy a bond now in 2023 versus 2021 during our all-time lows, your interest rates are going to be a lot higher. Selling those at a loss resulted in SVB not being able to really pull out all that money for these companies. And then what happens? These companies and people start to panic. And then what we get is a bank run. That's when everybody rushes to the bank similar to 2008, they rushed to the bank to pull out their money. And again, this isn't just, $2,000, $50,000, $100,000. This is millions of dollars into the billions of dollars that people and companies are trying to go and pull out of the bank. And what happens? The bank can't cover it and they financially collapse like we have seen. And this followed suit and can lead to panic amongst people saying the banking system isn't holding up. We need to go get our money while we can. And panic is something that we don't want to do when it comes to the banking system. One thing you do need to do is be smart and don't be over leveraged. How I want to relate this situation to personal finance for the individual is, I know I'm not putting in millions of dollars into a bank. However, I wouldn't be over leveraged with holding cash in a bank, no matter what my portfolio looks like, no matter how much I have. The reason for it, banks are FDIC insured up to $250,000. That is the federal government saying, we will give you $250,000 if anything happens to this bank. Well, what happens when you have $300 million in that bank? You're SOL. You're gonna lose all of that money except for the $250,000. Now, it looks like the federal government is looking to bail out those individuals and those companies that have over the $250,000 mark, which, debate that in the comments. Let me know your thoughts on that. I have other thoughts on that, and maybe we can make a video on that another day. But that looks like what the outcome is going to be. Other options or other banks and stuff to get together, put some money together in order to help bail out SVB, Signature Bank as well. This helps show you that diversification in your portfolio is a must. In your personal portfolio, don't hold over $250,000 in your bank account. If you need to get another bank account, that might be a smart play in order to help spread out that wealth. Other great options are to invest it. Shoot, why don't you go buy a treasury bond with the US government? Holding a 2% return rate, 4% return rate, 6% return rate. That is going to be guaranteed by the federal government, and you're not going to lose that due to a bank collapse. Other things that you can do is go invest, make sure you're maxing out your Roth IRA. Go open a brokerage account. And instead of investing in a single stock or investing in SVB, because that's not looking so good right now, go and put it into a S&P 500 index. Look at index funds. You might see a small dip, or you might see a dip because of this bank collapse, especially if you're heavily invested in the banking industry. But over time, the stock market holds true and will increase, even with a temporary decrease. So again, the main reason that this happened, it turns out, is due to a tech boom, and then companies needing their money, essentially calling due that, hey, I need my cash. The SVB being over leveraged with all that cash in treasury bonds, trying to sell those bonds at a discounted rate and losing money, not having the money. Then a bank run happens and boom, we see a collapse of a bank. Hopefully this doesn't happen every 15 years or so like it's shown happening now. But just be wary, and if you have any other details, want to discuss this further, open my mind to what happened at Silicon Valley Bank, what this could lead to, and other ideas like that, let me know and hit me up in the comments. Like the video, subscribe to the channel, and more content is on its way.